A bullion merchant stands behind the counter, watching something he has never seen before in 30 years of business. Silver prices dropping on screens, yet purchasers flooding through the door, premiums exploding to levels that defy logic, physical metal vanishing from inventory within hours, while futures markets tell a completely different story. 3 institutional analysts made quiet phone calls last week, not to buy silver, but to ask a question no one is discussing publicly. What happens when the paper market and physical market stop speaking the same language entirely? And one merchant whispered something that changes everything. The premium is not the problem. The premium is the warning. Welcome back. This is your OG John AG. Now, let me ask you something the way I could ask a gentleman who's seen a few decades pass by. You've watched markets long enough to know when something doesn't add up, haven't you? So do me a favor. Hit that subscribe button like you're marking a page in a book you'll need to reference later. Because what we're about to discuss, you'll want to come back to this and drop a comment below. Tell me where you're watching from. What city? What country? I want to know who's paying attention right now. Because geography matters when monetary transition begins. Let's continue. Last Tuesday morning, a bullion merchant in Dallas opened his shop at 9 o'clock. By 9:15, his phone had not stopped ringing. By 10:30, there was a line at the counter. By noon, he had sold more silver in 3 hours than he typically moves in 3 weeks. And the strange part, the spot price of silver had just dropped 4% overnight. This is not how markets are supposed to work. When prices fall, demand usually cools. When assets decline, buyers hesitate. But something different is happening in the physical precious metals market right now. Something that contradicts every chart, every technical indicator, every paper market signal. The merchant stood there that afternoon, looking at his inventory board, and realized he had a problem. Not a profit problem, a supply problem. He had purchasers with cash, ready to buy. But his distributors were quoting him delivery times of 3 to 5 weeks for standard silver products, 3 to 5 weeks, for inventory that used to arrive in 3 to 5 days. He called his primary supplier, a major distributor who services dealers across the southwestern United States. The supplier told him something he had never heard before in 28 years of business. We are allocating. We cannot fulfill all orders at once. First come, first served. Allocation. That word does not appear in normal market conditions. That word appears when supply chains break, when demand overwhelms production, when the system cannot keep pace. And here is what makes this moment different from previous surges. The premiums. A customer walked into that Dallas shop on Wednesday. He wanted to purchase 100 ounces of silver rounds. The spot price on the screen above the counter showed silver at $29 per ounce. But the merchant quoted him $34.50 per ounce, $5.50 over spot. The customer paused, looked at the screen, looked back at the merchant, and asked the question everyone is asking right now. Why is the premium so high when the price just dropped? The merchant explained it carefully. The spot price you see on that screen, that is the paper market. That is futures contracts trading in New York and London. That is not physical metal. Physical metal is what you hold in your hand, and physical metal, right now, is in short supply. The customer thought about it for 30 seconds. Then he said, "I will take it." He did not negotiate. He did not walk away. He purchased 100 ounces at a $5.50 premium because he understood something that many market observers are missing. The premium is not a markup. The premium is information. It is telling anyone who will listen that the physical market and the paper market are diverging. And when these two markets diverge, history shows that the physical market eventually wins. Because paper contracts can be printed, but physical silver cannot. Now, this is not just happening in Dallas. Reports from bullion merchants in Phoenix, Atlanta, Chicago, and Toronto are showing the same pattern. Increased foot traffic, elevated purchase volumes, extended delivery timelines, rising premiums. One merchant in Ontario reported that his silver inventory turned over completely in 72 hours. He restocked on Thursday. By Saturday afternoon, he had sold through again. Meanwhile, the futures market shows a different picture entirely. Open interest remains elevated. Short positions are concentrated among a small number of large traders, and price action suggests continued downward pressure. So the question becomes, who is correct? The paper market, which shows silver under pressure and vulnerable to further declines, or the physical market, which shows silver disappearing from shelves while purchasers pay premiums that would have seemed absurd 6 months ago? The merchant in Dallas has his own theory. He has watched precious metals markets for 3 decades. He has seen rallies, corrections, crashes, and recoveries. But he told a customer on Friday something he does not say lightly. This feels different. This feels like 2008, but earlier in the cycle. And then he said something else, something that should make every serious investor pause. The people buying right now, they are not traders, they are not flipping, they are stacking. And when stackers show up in volume, it means they see something the market has not priced in yet. The question is, what do they see? There's a number that Wall Street watches, but rarely discusses with retail investors. It is not the Dow, not the S&P, not even the VIX. It is a ratio, gold divided by silver. And right now, that ratio is sitting at a level that has only appeared a handful of times in the last 50 years, 92 to 1. That means it takes 92 ounces of silver to equal the value of 1 ounce of gold. A financial analyst in London pulled up a chart last Wednesday. He went back to 1980, then 2000, then 2008, then 2020. Every time this ratio pushed above 85, something significant happened within 18 months. Either silver exploded upward or gold collapsed downward, or both moved in ways that brought the ratio back toward its historical mean. The mean over the past century sits around 60 to 1. Right now, we are 32 points above that mean. That is not a small deviation. That is a structural dislocation. And here is what most people do not understand about silver. It is not just a monetary metal anymore. It is an industrial metal with monetary characteristics. A solar panel manufacturing plant in Germany uses approximately 20 grams of silver per panel. The global solar industry is projected to install over 400 gigawatts of capacity this year alone. That requires roughly 3,000 metric tons of silver just for solar. Then there is electronics. Every smartphone, every computer, every vehicle with electronic components. Silver is irreplaceable in these applications because of its conductivity properties. You cannot substitute copper. You cannot substitute aluminum. The performance drops too much. So while gold sits in vaults, appreciated but idle, silver gets consumed. It gets used, embedded into products, scattered across landfills, lost to recycling inefficiencies. The Silver Institute published a report last year. It showed something that should concern anyone paying attention. Global silver mine production has been essentially flat since 2016. Demand has grown by 14% over the same period. And the deficit is being filled by above-ground stockpiles that are quietly depleting. One mining executive in Peru was asked in an interview last month, can production scale to meet growing demand? His answer was immediate, not at current prices. Because here is the reality of silver mining. 70% of silver comes as a byproduct of copper, lead, and zinc mining. Only 30% comes from primary silver mines. That means silver supply is not determined by silver demand. It is determined by demand for other metals entirely. If copper prices stay soft, silver supply stays constrained, even if silver demand is screaming. Now, back to that ratio. A wealth manager in Singapore did something interesting last week. He took $10 million of client capital that was sitting in gold, and he rebalanced 20% of it into silver. Not because he thinks gold will fall, but because he believes the ratio will compress. If gold stays flat at $2,400 per ounce, and the ratio moves from 92 back to 70, silver would need to trade at $34 per ounce. That is a 16% gain, just from ratio normalization. But here's where it gets more interesting. What if gold does not stay flat? What if central banks keep buying, geopolitical tensions keep rising, and gold pushes toward $3,000 per ounce? And what if, at the same time, the ratio compresses to 60? That puts silver at $50 per ounce. From $29 today to $50, that is a 72% move. And the wealth manager in Singapore said something to his clients that stayed with them. Gold protects wealth, silver multiplies it, but only if you position before the ratio corrects. One of his clients asked the obvious question, what about the paper merchants? What if they keep suppressing the price? The wealth manager pulled up a different chart. It showed COMEX silver inventories over the past 18 months. The line was dropping, not steadily, but persistently. He pointed at the screen and said, paper markets can suppress price, but they cannot create physical metal. And when inventories drop below a critical threshold, paper price becomes irrelevant. Physical price is all that matters. That threshold. No one knows exactly where it sits, but every bullion merchant, every refiner, every major dealer, they are watching the same inventory numbers, and they are quietly asking the same question. What happens when the paper market writes a contract that the physical market cannot deliver on? A retired banker in Phoenix did something unusual last Thursday. He walked into 3 different bullion shops within a 4-hour window. He was not comparison shopping for the best deal. He was conducting an experiment. At the first shop, He asked for a quote on American Silver Eagles. Spot price, $29.30. Dealer price, $35.75. Premium, $6.45 per ounce. At the second shop, same question. Spot price, still $29.30. Dealer price, $36.10. Premium, $6.80 per ounce. At the third shop, the merchant did not even hesitate. $37 even, and I have 12 left. The retired banker stood there, doing mental math. 25% premium over spot. In his 30 years working for a regional bank, he had never seen premiums this detached from underlying asset prices. Not in bonds, not in commodities, not in currencies. He asked the third merchant a simple question. Why? The merchant leaned against the counter, arms crossed, and gave him an answer that explained more than any financial report could. Because I cannot replace what I sell. My distributor told me this morning, 4 to 6 weeks for Eagles, 4 to 6 weeks. I have customers calling me every day asking when inventory arrives. If I sell these 12 coins today at $37 and spot drops to $28 tomorrow, I still cannot restock at $28. I will restock at $35 if I'm lucky. So the premium you are paying, it is not profit, it is survival. That answer reveals something critical. Premiums are not arbitrary. They are not greed. They are information translated into price. And right now, that information is saying something the futures market refuses to acknowledge. Physical silver is unavailable at paper prices. A metals analyst in Chicago pulled historical premium data going back to 2008. He mapped premiums against major market events, the financial crisis, the European debt crisis, the pandemic. Every time premiums spiked above $4 per ounce, within 6 months, spot price followed. Not immediately, not in a straight line. But eventually, the physical market forced the paper market to adjust. Because here's what most investors miss. The paper market sets the price, but the physical market sets the availability. And when availability contracts, price becomes negotiable. One coin shop owner in New Jersey told a story last week that illustrates this perfectly. A customer came in wanting to sell a monster box of Silver Eagles, 500 ounces. The spot price was $29.50 normally. The shop would buy it $2 under spot, $27.50 per ounce. But the owner looked at his empty display case, looked at the appointment calendar showing 12 people scheduled to come in asking for silver, and he offered the seller $31 per ounce, $1.50 above spot. The seller was confused. You are paying me over spot? The owner nodded. Because I can sell every one of these coins today at 36, and I cannot get inventory from my distributor for 3 weeks. So yes, I'm paying you over spot. That transaction, that single moment, that is the premium structure breaking down in real time. Now, some analysts argue this is temporary. They say premiums always compress when price stabilizes. They say mints will catch up, supply chains will normalize, and premiums will return to $2 or $3, maybe. But there's a different scenario, one that historians of monetary systems recognize immediately. In 1933, when Roosevelt issued Executive Order 6102, gold was confiscated at $20.67 per ounce. But in the months leading up to that order, physical gold was trading at premiums of 12 to 15% over official government price. People were not stupid. They saw what was coming, and they paid the premium because they understood the alternative. In 1980, when silver hit $50 per ounce, premiums on coins were running $8 to $12. People were paying $62 for $50 silver. And looking back now, those buyers were not wrong. They were early. A financial advisor in Austin told his clients something last week that made several of them uncomfortable. The premium is not the cost of buying silver. The premium is the cost of certainty. You're not paying $6 extra per ounce. You're paying $6 to guarantee you own something physical in a world where paper claims are multiplying faster than physical supply. One client pushed back. But if I wait, premiums might drop. The advisor pulled up his inventory tracking sheet. It showed requests from clients over the past 90 days. 47 requests for silver. He had fulfilled 31, 16 were still waiting. He looked at the client and said, "You can wait for premiums to drop, but what if they do not? What if instead availability drops?" That question, no one has a comfortable answer for. A hedge fund manager in Connecticut made a decision 3 weeks ago that puzzled his colleagues. He allocated 5% of a $200 million fund into physical silver. Not silver ETFs, not mining stocks, not futures contracts, physical metal stored in a private vault in Switzerland. His partners questioned the move. Why silver? Why physical? Why now? He pulled up a single chart on the conference room screen, global debt to GDP, across major economies. United States, 123%, Japan, 264%, China, 88%, but rising faster than any period in modern history. He let the numbers sit there for a moment. Then he said something that changed the entire conversation. We are not investing in silver. We are purchasing insurance against a monetary system that has run out of options. Because here is what central banks will not say publicly, but what their actions reveal clearly. They are trapped. Raise interest rates, and debt service costs become unsustainable. Lower interest rates, and inflation accelerates beyond control. Print more money, and currency debasement continues. Stop printing, and the system contracts violently. There's no clean exit. There's only delay. And every month of delay adds pressure to a system already stretched beyond historical limits. A currency strategist in London wrote a private memo to clients last month. It did not make headlines, but it should have. He analyzed every major fiat currency collapse over the past century. Weimar Germany, Zimbabwe, Argentina, Venezuela, Lebanon. Every single one followed the same pattern. First, government insists the currency is stable. Second, small cracks appear, inflation ticks higher, but remains manageable. Third, confidence breaks, not among the poor, but among the wealthy. Fourth, capital flight accelerates faster than policy can contain. Fifth, the paper system collapses, and only physical assets retain value. He ended the memo with a single line, "We are somewhere between stage 2 and stage 3. Now, this does not mean the dollar collapses tomorrow. It does not mean hyperinflation arrives next month. But it does mean the probability of monetary disruption is higher now than any point since the 1970s. And in that environment, physical precious metals are not speculation. They are positioning. A business owner in Texas made a quiet decision last year. He took 10% of his cash reserves, money sitting in a business savings account earning 4%, and converted it into gold and silver, 70% gold, 30% silver. He told his accountant, who immediately warned him about opportunity cost. That money could be working for you in the market. The business owner listened, then responded, "That money is working for me. It is working as insurance. If the market continues up, I still have 90% exposed. If the system breaks, I have 10% that does not depend on anyone's promise." That is the framework. Not all in, not betting the farm, but not ignoring the signal either. Because here is what the premium surge is really telling anyone willing to listen. Smart money is not waiting for confirmation. Smart money is not waiting for the bottom. Smart money is accumulating, quietly, consistently, while prices are still accessible and availability still exists. A precious metals dealer in Nevada said something last week that should be written down. The people buying today, they are not asking if silver will go to $50. They are asking what happens if the system that prices silver stops functioning the way it has for the past 50 years. That is a different question entirely, and it requires a different answer. The answer is not buy everything today. The answer is not wait for the perfect entry. The answer is position systematically, in size appropriate to risk tolerance, and recognize that the cost of being wrong about timing is far less than the cost of being wrong about the system itself. Because if the paper market and physical market continue diverging, if premiums continue expanding, if delivery timelines continue stretching, if central banks continue printing, if debt continues compounding, then the question is not, is this the bottom for precious metals? The question becomes, what is the cost of waiting to find out? And that cost may be measured not in percentage points, but in availability itself. The merchant in Dallas, the one who watched his inventory disappear in 72 hours, he put a sign on his counter last Friday. It did not say sold out. It said something far more telling. Next delivery, date uncertain. Uncertain. That word does not belong in functioning markets, but it is appearing more often now in bullion shops, in refinery reports, in distributor communications. Uncertainty is becoming the norm, and for those paying attention, that is not a reason to panic. It is a reason to prepare.